If your order block doesn't tick the 5 requirements that we're going to speak about in today's video, you simply don't trade them. What a lot of people do is mark out the last green candle before move to the downside or the last red candle before move to the upside, and then they wait for the retest, they long or short at retest, and they pray that it works. In today's video, we're going to discuss 5 non-negotiables that I need to see in order to be willing to trade a high probability order block. Okay, so we have established that an order block is, for example, the last red candle over here before an impulse up, or the last green candle before an impulse to the downside. Now, an order block means that when demand is the order block, that a lot of buy orders over here were being filled, and that so many buy orders were being filled that we got to push towards the upside. Okay, so buyers were filling their positions over here and then pushing the price towards the upside. But we know that buyers can only fill their positions, the bigger players in the market, if
there's a lot of liquidity.
Exactly. They need that liquidity to fill their orders, because if there's not liquidity available, they can't fill those orders. So in order to know that while that order block was being formed, actually a lot of buyers were stepping in, right? We know that that order block needs to be formed while price is pushing into that liquidity pool, right? Do you understand why that's the case? So if we just form a regular low over here, right? A price pushes beneath that low, and then it forms that last red candle over here before an impulse up.
Yeah.
But there was no liquidity resting here, no liquidity, right? It's just a regular low. Now, is this a reliable high probability order block?
No.
And why?
Because the buyers need liquidity to fill their buy order.
Exactly. So if there's no liquidity available, they could not fill their orders over here.
No.
So even if price bounces, they're not going to defend that order block, the demand area over here, because they were not positioned, because there was no liquidity available to fill those orders. Yeah. Okay? So that is why it's so important to always be aware of the fact where the liquidity is resting on the chart, because then we know, if we know where the liquidity is resting, we know potential areas on the chart, potential price levels, where the bigger players can potentially fill their buy or sell orders. Okay? Yeah. So now let's say we push up like this. And then we know, okay, there's a lot of liquidity resting beneath these lows, right?
Yeah.
And then price pushes to the downside. This is that last red candle again, okay? So this is that order block before we push to the upside.
Now it's reliable.
Exactly, and why is it now reliable?
Because there's liquidity.
Exactly, there's liquidity resting, so this is a valid liquidity sweep. And while it's sweeping that liquidity beneath these lows over here, this is where the biggest players can fill their demand, their buy orders, right? Before pushing the price up. So if price is then going to come back down again to retest that demand, they're going to defend it because they don't want their positions to be underwater. They want to make profit.
Yeah.
So liquidity grab is pivotal, because without grabbing the liquidity, smart money won't be able to fill their orders. If smart money is not able to fill their demand or supply orders, why should we trust the order block? The order block cannot be trusted if the demand that was being filled or the supply that was being filled wasn't smart money's demand or supply. And we know that smart money needs the liquidity in order to fill their own bigger buy or sell orders. Huh? Alright, so once we have established the liquidity, right, where they are potentially filling those orders. Yeah. So this is that last red candle once again before we're going to get that leg to the upside. Now we know, okay, we have liquidity here, so potentially smart money, when price is pushing into the liquidity pool, can fill their orders. The second requirement that we need in order to know that actually a lot of players were stepping in over here and filling their orders is a market structure break. Because this market structure break is telling us that there were so many buyers stepping in over here that they gave the price such a strong push to the upside that all these sellers that sold over here, that gave us that lower low, remember? So a lot of sellers were selling over here that gave us a lower low, are now underwater, you see? Because everyone that is shorting or selling the price on this push to the downside is now, when price is trading over here, underwater.
And what kind of guys are selling? Just the
people that are expecting the price to go down. So that can be people that are entering shorts, right? So a short position, or people that were maybe holding buy positions over here and then selling their buy positions over here for profit. That is also adding to the sell pressure. But everyone that is shorting over here or selling over here is now underwater, which means that if they are underwater, the bulls are taking control potentially, right? Because if they're underwater, they're freaking out, right? Oh my God, I sold or I shorted and now I'm in a loss. I also want to get in, you know? So they're closing their shorts, and if you close your short, you're adding to the buy pressure, or they're also going to buy that position, that same. And what is that going to do? It's going to fuel the price potentially to the upside.
Even more.
Or, for us, it's now indicating that bulls were stepping in, indeed, over here in that liquidity pool.
Yeah.
Because we have the second indication, right? I'm going to explain two more indications, and then it needs to align with something. But this market structure break gives us that trigger to know, okay, second indication is there. Bulls potentially stepped in over here. So this is a strong order block that we need to defend if we retest it over here.
Yeah.
Okay? So let's say you have that liquidity sweep over here, right? Form that last red candle. But then this is where you get your market structure break. If price only does this, we're not gonna play along over here on this retest yet, right?
No.
Because we need to wait for the market structure break over here first, and then we can play it. Because that market structure break is confirming to us or giving us more certainty that a lot of buyers were stepping in this area over here below this liquidity.
Yeah.
Okay, so that is requirement number 2. Market structure gives us the confirmation if bulls or bears are actually in control after forming the order block. If, while forming the demand zone or the order block, a lot of bulls actually stepped in and filled their buy orders, we want market structure to confirm the fact that they actually filled those orders. Because if enough orders were being filled and enough sell orders were being absorbed, bulls are taking control again of the market. Now, how can we get the confirmation that bulls actually filled their orders in that order block and are actually getting back in control if they are confirming the market structure break after the order block was being formed? So after the order block was being formed, we always need a high probability market structure break in order to actually acknowledge the fact that we are looking at a high probability demand or supply area. You remember what a fair value gap is, right? A gap in fair value, because the price shoots up so fast or goes down so fast that you get a gap in fair value. For example, between $10,000 and $20,000, you have a gap.
Yeah.
That gap is basically indicating that there was so much demand coming into the market, right? Or supply, that price shoots up very fast or shoots down very fast.
Yeah.
So that is the third requirement, the third indication that we need in order to identify a high probability order block. So let's say once again, right? Liquidity. Last red candle over here. Break of structure, right? So demand was coming into the market over here while sweeping that liquidity that we are kind of sure of. But now we want to know, okay, how much demand was actually coming into the market over here? Was there so much demand coming into the market that price creates a gap over here in fair value? A FVG is what we call that. Fair value gap. Because if we get that fair value gap, once price is breaking away, it is indicating that there was a lot of demand coming into the market, remember?
Yeah.
Because there's so much demand coming into the market while we are forming this order block, and order block and demand are the exact same thing, that price shoots up that fast that it's putting in a gap in fair value. And that gap in fair value is indicating that there were a lot of buyers stepping in, right?
Yeah.
So we need that fair value gap in order to once again give extra probability to this order block to succeed.
Yeah.
A higher certainty for this order block to hold. Because the fair value gap is once again indicating and giving us more certainty that there were a lot of buyers stepping in this order block over here. You see?
Okay.
So now let's say we have liquidity building up, sweep, push up, and
This is the market structure break.
this is the market structure break, indeed. Like this, and this is our order block. Okay? Would you now be potentially interested in a long over here, in a buy position, when we get a retest like this?
What do you want to be when you grow up?
Oh, huh?
So we have a fair value gap over here, right? We have our liquidity sweep, we have our market structure break, MSB. Would you now be interested in a potential buy position when price comes back down to this order block?
Yeah.
Exactly, right? Because we have 3 requirements already being checked.
Mm-hmm.
And there's one more requirement that I will explain to you in a little bit. But now, let's say we have this liquidity sweep, right? And then this, where we have our market structure break, and then price does this. Okay, so we have our market structure break, and then this is our order block, right? But we have no fair value gap, right? Because you see price is not pushing up very aggressively, no, it's slow grinding to the upside. Would you now be interested in a buy position over here?
No,
And why?
because I don't see any fair value gap here.
Yeah, okay, what's the problem when we don't see a fair value gap?
There's not a straight dump to the upside, right?
Not a straight pump to the upside, yeah, okay.
Pump.
Yeah, but I get that. We are slow grinding up, so we have no fair value gap. But why is it a problem that we have no fair value gap?
That there's no confirmation.
Yeah, okay, confirmation of what? What is the fair value gap confirming to us? Why do we need a fair value gap, like I've just been explaining?
To know if we're going for a long position.
No, why do we need that fair value gap, bro? I've just been explaining it to you 2 minutes ago, literally. We need that gap in fair value to know that a lot of buyers were stepping in over here. Because if a lot of buyers were stepping in, then price shoots up very aggressively, creating a gap in fair value. If not a lot of buyers are stepping in, then price is just slow grinding like it is over here.
But okay, but
Now ask your question.
but why? I don't even see a fair value gap.
No, you can see that with the candles.
Yeah.
But I was just explaining the slow grind up is basically indicating that there's no gap in fair value. Usually you have one candle, right? A second candle and then a third candle, and then this is your gap, you know, between the high of this candle and the low of this candle. And this is your gap, you see? So you have 1, 2, 3 green candles, the low of the third green candle and the high of the first green candle are creating that gap. So then this is your FEG, you see? But it's basically the same as price doing this and price doing this, you know? Right?
Yeah.
So this is that gap because a lot of buyers are stepping in, and over here there's not a lot of buyers stepping in because they're not even creating a gap. So there's not so much demand for that asset, because if there's a lot of demand for that asset, price shoots up very quickly and creates a gap in fair value.
Yeah.
So once again, I'm gonna ask you the same question. I hope you understand. If we have push down, liquidity, push down, order block, right? And then price does this. We have no gap in fair value, right? Because it's once again pushing slowly up. Now price does this. Are you interested in buying over here?
No,
And why?
because there's not a lot of buyers.
Then how do we know that there's not a lot of buyers?
Because I don't see a fair value gap.
Exactly. So you want that fair value gap to be visible in order to know, okay, there were so many buyers stepping in over here, the price shoots up very aggressively, that it puts in a gap in fair value. Now we know that if it retests the demand, then I'm interested to buy over here. But if it just does this, slow grind up, no gap in fair value, yeah, there's not so many buyers that were stepping in over here. So we had the liquidity sweep that we need in order to fill the orders and to create the actual order block in order to trust it. Then we had the market structure break. That was the first indication that bulls or bears are actually getting back into control after filling their orders in the order block. But a fair value gap is the second indication that bulls or bears are actually getting back in control in the market. Because if we create a strong fair value gap after the order block was being formed, which we can also call a breakaway gap after the order block has been formed, it is indicating that while the order block was being formed, there were either so many buyers stepping in or so many sellers stepping in that we created a very impulsive move to the upside or towards the downside after creating that order block. And that very impulsive move is being recognized by the fair value gap, and that fair value gap like I said, is the second indication that a lot of buyers or sellers were stepping in while the order block was being formed. So now we have had 3 different requirements. There's one more requirement. But before I dive into that final requirement that we need to execute trades on those order blocks, important is to always understand that if you have, for example, a very strong bullish order block over here, right? So we have that sweep, we have our order block over here, right? We have the market structure break, so MSB over here, and we also have that fair value gap, FVG over here, okay? So we have a lot of requirements, and we have a very, so that means that, okay, I'm gonna explain one more requirement later in this video to you, but that means that we have a strong order block over here. But if the bigger picture is telling us that Bitcoin is trading at 100K, right? But we expect Bitcoin the upcoming weeks to go to 90K over here instead of 110K over here for whatever reason, right? That is a topic for a completely different video. So our higher time frame analysis, our bigger view for the coming week or weeks on Bitcoin is that Bitcoin is going to trade towards $90,000. Would you then still be interested to buy Bitcoin over here?
I would be more suspicious.
Yeah, I would not be more suspicious. I would not be more suspicious. You would not be. You do not have to be more suspicious. You just don't want to buy here because you're expecting Bitcoin in the coming week to go to 19K or maybe coming 2 weeks. So why would you buy here, right? It doesn't make any sense. So you have everything on the chart aligning, but if it doesn't align with your bigger picture view and your bigger picture expectations, all of this is completely irrelevant, okay? So the conclusion is that regardless of your trading system, regardless of your triggers, regardless of your executions or your high probability or low probability order block, it needs to align with the...
look at the bigger picture.
Exactly, exactly. Where do you expect price to trade towards next? And based on that expectation...
And what kind of trades are there?
Like I
news
said,
events?
That's a whole different topic for a different video. But before you start looking at this, you first determine
Bigger picture.
bigger picture.
Baby, baby, feel these sweet sensations. Yeah. Honey, honey, love's like a superstar. Yeah, yeah. She got a promise of love.
Higher time frame context is so key and so pivotal, guys, because regardless what triggers or confirmations you are waiting for, or regardless how you are executing your trades, right? Order blocks is a way of executing your trades. If it doesn't align with higher time frame context, if it doesn't align with your bias, and if you are not aware of where price has come from and where price is likely going to trade towards next, any trigger that you want to trade, any order block that you want to trade, it's all completely irrelevant and they will still likely fail. At least the probabilities of them to succeed will be a lot lower compared to a situation where your order block does align with your higher time frame context. So before you start looking at triggers or confirmations, before you start looking at executions, first ask yourself the question, where did price come from and where is price likely going towards next? If you think price has come from a sell-side liquidity pool and afterwards is likely going to trade higher, you're going to await bullish triggers and bullish confirmations, and then you are going to wait for high probability order blocks, bullish order blocks, to be formed in order to execute your trades. But always first make sure to understand the higher time frame context before you start seeking for high probability order blocks. Okay, so we have determined that Bitcoin is going to trade towards 110K, for example. So our bias is bullish. Our higher time frame context is expecting price to go to $110,000. Then we generate liquidity here, yeah. We get that sweep, form that lost the red candle over here before that leg to the upside. We have a MSB. We have a
Fair value gap.
FVG. everything is there. We can start executing our trade.
Yeah.
But if it would be this simple, everyone would be able to do it. And this is where most people fuck up. Because most people are now like, okay, if price pushes back down to this demand over here, right? I'm gonna buy Bitcoin over here with my stop loss over here, and I'm gonna target $110,000. But this is not the way it works. Before you want to execute your long inside a demand or inside a supply area, you need price to form an inducement. And an inducement is basically price pushing to that area, but not touching that area, front running that order block. Do you know what I mean with front running?
Yeah.
Slightly not touching
Slightly
it.
not touching it.
And then price, for example, generating liquidity again over here above that order block.
Okay.
If you now front run that order block, and after front running it generate liquidity above that order block, then we can play a long if we get a push down towards that order block. So if we now push down into that order block, we buy over here, right?
Yeah.
With our stop loss over here, and then we target $110,000. But why do we need to front run that order block and generate liquidity there again? Why do we need that? Why is it so important to generate liquidity over here above that order block or inside of that order block?
To know if there will be people buying.
Exactly. Exactly. Because without liquidity above or inside of this order block, they can't buy. And if they can't buy, the bigger players, why would they push the price again to the upside? Right? We need big buyers to step in over here in order to push the price towards the upside. If only us two are going to buy over here, we don't need all of that liquidity, of course. We're not going to push the price to the upside.
No.
Right? Big players once again need to start buying over here. So you want that liquidity once again first to be engineered above that order block or below. If you have a bearish order block over here, you want price to then mitigate or engineer liquidity over here. You see, this is the order block, and then you can play the short.
Okay.
You see? Or you can play the long over here. So that inducement is the final requirement that we need to play the order block, okay? So basically we have three requirements to confirm whether it's a strong order block, liquidity sweep, break of structure, and fair value gap indeed. Then it needs to align with a higher time frame context. But to actually execute your trade, you also need an inducement.
Okay.
Now let's navigate towards a real-time example, which is currently happening on the Bitcoin chart as we speak. Because what we can see is that Bitcoin was sweeping major liquidity over here. After sweeping that liquidity, we can see that we're looking at some local liquidity sweeps over here. And we had these equal lows right here. We sweep those equal lows, as we can see. After sweeping those equal lows, guys, we can see that the price of Bitcoin got a push to the upside that gave us a break of structure over here. So requirement number one, check, liquidity sweep. Requirement number two, check, break of structure towards the upside. And we can see that while getting the break of structure towards the upside, the price of Bitcoin is also putting in a bullish fair value gap over here on the 1 hourly time frame, and also a bullish fair value gap over here on the 30-minute time frame as well. Meaning that if I now mark out that last red candle before that impulse towards the upside over here on the 30-minute time frame and extend that one towards the downside, then we have our three requirements for a high probability order block. We have a liquidity sweep, we have a market structure break, and we have a bullish fair value gap, indicating a lot of buyers that were stepping in to the demand area right over here. Now guys, this also aligns with our higher time frame context, because we can see where does price come from. It comes from mitigating this sell liquidity, also mitigating the liquidity beneath all of these lows. And while doing this, we have been building up a lot of buy sell liquidity above the highs over here. So price is coming from an aggressive purge of a sell liquidity pool where they could have accumulated buy orders over here. And now we have a drawn liquidity resting right over here. So we expect price to trade higher. So this bullish high probability order block over here that I've marked out and that we have determined aligns with our higher time frame context. So the final requirement that we are looking for, guys, as you know by now, is an inducement above this order block before we can use it to execute trades. Now what we can see is the price was front running the order block over here, and afterwards is seeing a push towards the upside, meaning that a lot of people are FOMOing into buy positions upon this push towards the upside with their stop loss beneath this low, making that low a valid inducement for this bullish order block. So it's very simple. If we now sweep this inducement into this bullish order block for Bitcoin, and this is a real-time live example, guys, I'll be a buyer of Bitcoin over here with my invalidation beneath that low, targeting that high time frame, draw liquidity right there. And this long position, based on everything I've explained in this video, can then potentially offer us an RR of 3.7. What we could see a few weeks ago on Bitcoin was some very interesting price action over here on the 1 hourly time frame, which resulted into a beautiful bullish order block, which resulted into a beautiful long position on the price of Bitcoin. Because what we can see is that if I navigate towards the 30-minute time frame, is that I can see that right over here, Bitcoin was building up a lot of sell-side liquidity by continuously sweeping through previous highs over here. So like I explained, we had a lot of liquidity resting beneath these equal lows. And what we can see is that the price of Bitcoin got an aggressive push to the upside to then indeed sweep that sell-side liquidity. Requirement number 1, check. After sweeping that sell-side liquidity over here, we can see that Bitcoin found its way back towards the upside and it put in a high probability market structure break right here for the price as well, which means that requirement number 2 was also a check. Now, while pushing towards the upside, we can see that on a 1 hourly time frame, we left behind a bullish fair value gap right over here. This bullish fair value gap, this bullish breakaway gap, was indicating a lot of strength from the buyers that were stepping in right over here where the liquidity was being swept. So we can indeed see that we were sweeping that liquidity right there, forming that order block before pushing towards the upside and putting in that high probability break of structure, while also putting in a bullish fair value gap, meaning that we have our 3 requirements for the price of Bitcoin over here to confirm this as a high probability order block. Now, before we then start looking at a potential execution near that order block targeting high levels, we first need to determine if that also aligns with our higher time frame bias. And it indeed did align with our higher time frame bias, guys, because we can see that we had a lot of liquidity that was building up towards the upside over here for the price of Bitcoin, right, with a lot of relative equal highs right there, after Bitcoin was mitigating for a pretty long period of time a major sell-side liquidity pool from here. So where does price come from? It comes from the area over here, and it is likely going to target that buy-side liquidity above the highs right over here. So indeed, the bullish order block that I've marked out in gray over here aligns with our bullish bias as well, because we have determined where price was coming from, and we also determined where price was going towards. So if I then go back to the 1 hourly time frame, although we are needing right now is an inducement, and we can see the price beautifully front-runned that bullish order block. Afterwards, it got a strong push to the upside. This push to the upside, obviously, as you guys know, is trapping a lot of people into longs right over here for the price of Bitcoin. And all those longs are putting their stop loss beneath the low over here, making this a valid inducement for this high probability order block. So that means that if we then get a retest of that high probability order block right there, we can put our invalidation beneath the low of the order block, targeting our high time frame target. And indeed, we can see that afterwards, price got an aggressive push into that order block. It looks like that order block is indeed holding. That is where we executed our long on Bitcoin. And eventually we can see that price found its way back towards the upside. And step by step, we analyze this as a high probability order block that aligned with our high time frame context. And this trade could have offered you an RR of 6.26. So you now know the difference between a high probability and a low probability order block. There's basically 4 requirements that we need to check: liquidity sweep, market structure break, fair value gap, and the inducement. But important is that those 4 requirements are always, and I mean literally always, in line with higher time frame context. So first figure out where the price comes from and where is price likely going to trade towards next. Now, if you guys do enjoy these kind of videos, make sure to smash the like button, subscribe to this channel, but more importantly, also follow the first link in the description down below, because it brings you to what I think is the best trading community in the space, Tribe Capital. You can test us out through that link for 14 days for just $1.